In today's video, we're going to cover 3 timely topics. AI, is it a bubble? Is it not? How should we think about it with our portfolio? 50-year mortgage has been introduced. Is that something we should consider a good deal or maybe not so much? And then the government shutdown just ended, and we're going to talk about that a little bit. So let's get right into it. My name is Joe Conroy with Harford Retirement Planners, and we hope you are well as you watch this video. So AI, artificial intelligence, there's been lots and lots of conversations with clients about it, so I figure it would be a relevant topic to discuss briefly in today's video. There's been a huge run-up in the AI-related investments. The chip makers, software, the huge mega tech companies are all in this race for AI dominance. And I'm getting a lot of questions that Joe, or Mike or Steve or whoever you're talking to, seems a little bit like the dot-com bubble back in the late 90s, and eventually the rug's going to get pulled out, right? Or this bubble will burst. Perhaps, right? Nobody knows exactly what the future is going to hold. It does seem like there's a lot of similarities to it, but let's talk about where some similarities are positive. So back in the dot-com bubble, there was this new technology, the internet, right? Which sounds funny because it's been around for quite a while now, but everybody was racing and you couldn't buy stock in internet, right? So you had to get some kind of proxy for that type of technology, and a lot of those ended up being pets.com and these different fly-by-night companies. They would just put .com and they would IPO and the price would triple or even more in a year until they didn't. The new technology that was so transformative and would absolutely impact almost every aspect of our life in the future or today was this connectivity of the internet. And what we found was the real money wasn't in pets.com or Broadcom or any of these other internet-related stocks, but just the value and efficiency that was unlocked by having such a connected world. All businesses, not just technological ones, but the Home Depots, banking, everything was able to be more efficient and therefore more profitable. As expenses go down in a business, profits can continue to grow. And after all, that is what the stock is based off of, is profits and future profitability. Is AI in a bubble? What if NVIDIA is way too high and that must come down? Well, these companies are a large part of the S&P 500 index, but they are not the only part of the S&P 500 index. And the way that we invest client portfolios are more diversified, and we're not chasing trends and trying to get out before the bubble does burst. So what that means is on the way up, you might not get the extreme growth that some of these bubbly type investments can offer you, but then when they eventually pop, if that is the case in this instance, we're also not going to get hurt as much as somebody who may be overweight into an AI-related investment. To sum things up with AI does have that transformative potential to make businesses operate more efficiently and eventually more profitable, which again is what the stock market is tied to over the long run. That, we believe, has a very good growth, bullish, positive impact on the market for the intermediate future. But in the short term, there could be more growth in these AI-related companies. It could be a sharp contraction. But at the end of the day, if you are diversified, you have an investment plan, it's well thought out, and it is custom tailored to your financial plan, I wouldn't worry too much about temporary volatility from an investment theme that maybe, its head got out a little bit in front of its legs. So those are our thoughts on AI. We're going to keep a close eye on it. But if you remain diversified and you have a well thought out portfolio, I would not get too wrapped up in any temporary declines in the market. As always, give us a call if you're curious before that happens or after. We're always there to have those conversations with you. All right, next up, a 50-year mortgage. My initial thoughts are, meh, right? Is that a technical term? I'm just not excited about it, and I did do a little bit of research, and I've got some numbers to share which will explain my thoughts. Let's just keep numbers real simple. So say we have a $500,000 mortgage at 6% interest rate. A 30-year mortgage with those numbers would be just under $3,000 a month. A 50-year mortgage of $500,000 starting balance and the same 6% Although the longer term mortgages would probably have a slightly higher interest rate, but let's just keep things simple to prove the point. The payment would be less. It would be $2,632, or a difference, 50-year mortgage would be $366 less on a monthly payment. Don't stop there. The next part is what's the most important part, and that is the total amount of interest paid. With a 30-year loan of $500,000 starting balance at 6%, the interest is just under $580,000 total over the 30 years. But look at the 50-year, and this is where the difference is so stark in contrast. A 50-year total interest payment under the same mortgage structure, almost $80,000 of interest, meaning a difference of $500,000 more in interest payments with the 50-year loan. There's also a growing trend in the auto industry that if you can't afford the payment on a 5-year loan, we'll stretch it to 6 or 7 or 8. I'm sure there's even 10-year auto loans out there. They probably wouldn't be too hard to find. There is generally a rule of thumb that if you have to amortize these loans over longer and longer periods of time, it's probably telling you that it might not be the most financially advantageous move to make. I don't know of any circumstances where I would get excited to recommend a 50-year mortgage to a client. Certainly not based on the leverage you have, the amount of principal that's being paid down on a monthly basis is just much less than a shorter term loan. Think real hard before you sign up for a hypothetical 50-year loan. I think stick with the 15 or the 30-year, depending on what your financial advisor would recommend. So 50-year loans for mortgages, those are our thoughts. Kind of, if you've heard my expression before, a little bit of a hairy lollipop situation. From a distance, lower monthly payment, I can actually afford that house now. But the closer you get and you look at it and analyze it, it becomes less and less appetizing. Sorry if that's a disturbing analogy, but it is one that I use often, and I thought it would fit well here. All right, lastly, let's talk about government shutdown. So as we record this video, it just ended. It ended the longest government shutdown in U.S. history of 43 days. Now, we've had a few of these over the past decade or more. So I went back and I looked. We've had, since 1977, we've had 21 funding gaps, which have resulted in 11 government shutdowns since the late 70s. So it's not super common, but it also isn't uncommon. Now, I'm going to talk about how this affects people in two very specific ways that we interact with folks on a daily basis. And the first is just the stock market. Do government shutdowns have an impact on the stock market? The short answer is not really. There is a little bit of a surprise that comes in when the government shuts down, and then it stays shut down a little bit longer than we expect. So that uncertainty does soften the market a little bit or create some pressure on prices to go down, but usually it's temporary and it isn't that great of an impact. Remember, longer-term returns in stocks are really tied to economic long-term trends and factors, profitability of the companies that you own, and if the economy is growing or shrinking. So government shutdowns don't have nearly as much of an impact on the stock market prices as a lot of people think they do. Putting the stock market aside, many families and individuals were absolutely affected by this very prolonged government shutdown. Many of our clients are government workers or servicing or working in ancillary different companies that service the government, and they were furloughed. So we're out of the woods, right? We're good. Government's opening back up. We got to kind of reactivate things. Well, unfortunately, there's another deadline of January 30th that we have to get through. Is there going to be a shutdown? Is there not? We don't know. So what I like to recommend to people that have been affected by a government furlough and potentially afraid of the next one, whether that's in January or some later time period down the road, we can't control it. So as individuals, we need to focus our time and attention on controlling the controllables. We can't control government as much as we would like to at times. But what we can control is our spending habits and maintaining that emergency fund. When the market's going straight up, people don't really want to sit on extra cash. They want to get that money invested, but that money is so important because there's a disruption in income. Or maybe if you're not affected by furloughs, you have emergency house repairs or family needs, where a million different things where these unexpected expenses come up, and usually they're not cheap, especially not these days. Maintaining an account or some type of accounts outside of your TSP or your 401k is just so important. That is something you do have more control over, whether how much money that you're able to put together and have for a rainy day fund, you have more control over that than you do if the government can shut down or not. So my advice to those watching this that are afraid of another shutdown and what that means to their personal financial situation is control the controllables. If you're going to get a big lump sum of money as you get back paid for the amount of time that you were furloughed, don't just go and spend it all because the holidays are coming up. Really see if you can. Try and put some of that money aside and then make that savings a regular habit, a part of your day-to-day life. I know almost all of our clients here do. And if you're not a client, I would strongly encourage you to create some type of plan that's set on autopilot so you don't have to think about it. So control the controllables, build that rainy day fund. Once you have enough sitting in cash, I would suggest investing beyond that cash amount so you do get some upside participation when the market offers it, but that money would still be available to spend if you need it in case of a shutdown, an emergency expense, whatever it might be. So those are the three things that I wanted to cover today. If there's anything I haven't mentioned and you'd want to talk to a financial advisor about it, I hope you feel comfortable reaching out to us. We'd love to talk to you. And as always, thank you for watching.